Hello, everyone. Joe Mass here. It's time for another market review. And so we're excited to share our thoughts and what's going on in the economy and where we think we might be going. So let's jump in. This is kind of a fun slide. Good economic news versus bad. So on one side of the coin, we have good economic news. So you think that's great. We have strong jobs report comes out. This is good economic news. So the market should run. And what happens? The market falls. It's actually bearish. And then on the other side of the coin, you get bad economic news and you're like, oh my gosh, the market's going to tank. And then, of course, the market rallies. So why does that happen? Well, why it happens is that if the market thinks that the Fed will need to raise rates because bad economic news came out and the economy is going to be performing poorly, there's a high probability of raising rates. And that means higher rates is bad for the market and the market falls. And then on the other side of the coin, it's the opposite effect. If there's bad news, the Fed might need to decrease rates to stimulate the economy. So lower rates is good for the market and the market rises. And so that's why sometimes when you hear about good economic news, it's actually bad for the market. And when you hear bad economic news, it's actually good for the market. So I just wanted to share that with you because last Friday we got the jobs report. We're getting some economic news out and it seems like it's good news, but the market drops. So I just wanted to give you a quick explanation as to why. Okay, we've seen this slide before. We show it frequently. On one side of the tails, we have investors that are worried about risk off. They want to be risk off, invest risk off because of the macro geopolitical risks out there. And last quarter, the third quarter, risk off was the winner of the quarter. And of course, on the other side of the coin, you have the investors that want to fight inflation and they're in risky assets trying to outpace inflation, and risk on assets were out of favor. Although they were good for the year, they were out of favor for last quarter. That rise in yields has really put a damper on the equity prices for last quarter. Okay, let's turn our attention to cycles. So every month we do a market cycle assessment, which you can think of that as the short-term tactical view in the market. We look at 40 factors. About a third of them are economic, a third are fundamental, and a third are technical. And this is our team of analysts, the way that we look to determine if we're bullish and bearish. And so right now, we have 34 out of our 40 factors are bearish, and 6 are bullish, and therefore the bears are in control right now with a score of 85% bearish and 15% bullish. Just a few weeks ago, we were inverted. We were 85% bullish and 15% bearish. So over the last 30 days, the market has really changed. Now, when we think of cycles, right, there's only a few things that make the markets go up or down. We've been teaching about these for a long time. What makes the market go up in a bull market is low inflation or inflation that's falling, interest rates that are low or falling, corporate earnings that are rising, and an accommodative Fed. And so that's what drives the market up, okay? Now, the same thing that drives the market up on the other side of the coin, right, can create a bear market. And that is inflation's higher rising, interest rates are higher rising, corporate earnings are falling, and the Fed is restrictive. So right now, we think we're probably right about here, where this arrow is. Again, last month we were over here, so the market's taking a little pullback. Okay. Again, we're trying to buy low and sell high, and so the emotional cycle that people have is disconnected from the market cycle. And the reason that is let's think about this. So after a bull market, all of your accounts are up, the 401k is up, you're feeling wealthy, and we come to you and say, hey, we think you should become really conservative now and move out of a risk on posture, move into a risk off posture. So sell your stocks and buy bonds. And you're going to look at us like, are you crazy? And why would I want to do that? I'm making a ton of money. So that's because we're getting ready to drop, okay? Or we might be getting ready to drop. Think about the other side. The market's come down, you spent a long recession, a long bear market, we're here at the bottom, and we come to you and say, hey, it's time to buy stocks again, or it's time to get back in the market. I mean, you're going to look at us and go, are you kidding me? I just came through, a market crash, a recession. There's no way I want to put stocks back in my portfolio, but that's what you should be doing. And so the emotional cycle we know is disconnected from the market cycle. So we like to remind investors of that so that they can be aware of their biases and try to remove some of those biases to help them become better investors. On the market score, we have a few bulls. So expected returns are higher than the long-term averages. The valuation metrics from the forward PE is a little bit lower than current, so that's positive. And at the time that we took this score, the S&P 500 was still above its 200-day moving average. On the bear side, volatility is increasing. The money supply has been decreasing. Interest rates are peaking out, and most technical indicators have been negative. So these are some of the factors that were in our model for last month, or on 9/30. On this slide, we're looking at our economic cycle assessment. And so once a quarter, we kind of look at the economic factors. And again, there's a mix of factors from technical and economic and fundamental. And here we're scoring the market at a 60-40. So we're 24 bearish factors and 16 bullish factors for a score of 60-40. And when we look at the economic cycle, okay, we think we're down here about E. Now the economy doesn't have to go from E to F to the bottom. It could skip across here. That'd be a soft landing, and we'll talk a lot about that in this video. Now let's think about this. Let's pretend that we come to you and we say, hey, all 40 of our economic factors are bullish. 40 out of 40 are bull. You're probably going to be really excited, right? But if that was the case, we're up here. We're probably up here at C. Even though the cycle can stay up here for a long period of time, 40 out of 40 bullish factors are actually bearish. And the inverse is true. If we're down here at a new low, if 40 out of 40 indicators are bearish, okay, that's usually the time to buy. And so the economic cycles have an inverse relationship to where you might think you should be when you want to buy low and sell high. So you can think of the economic cycle as the long-term strategic work and factors that we look at, and the market cycle assessment is the short-term tactical factors that we look at. And so again, we're going to look at the combined evidence to help us make a better decision with managing the portfolios. So when we look at the economic scoreboard, we can see that on the bullish side, employment, inflation, equity performance year to date in the services index, ISM services index, are kind of on the bullish side. And on the bearish, we have a negative outlook and sentiment. Economic growth in GDP is slowing compared to historical averages. Monetary policy is tightening, and then the manufacturing sector, as measured by the ISM, is below 50 and in a contraction area. Now, we've shown you this chart before. What we're talking about here is coming into the year, a lot of us thought that there was a lot of risk in the economy. Rates are rising, there could be a recession, the probability models were high, which we'll look at in a few slides. And so at that time, if you look at history, you'd be thinking that we should be in more defensive cycles, or sectors, more defensive sectors. But what you'll notice is earlier this year, those defensive sectors, indicated by those little red frowny faces, were the sectors out of favor. And now this quarter, okay, that switch, we have energy, financials, and the telecoms back in favor. Another thing that's kind of interesting and confusing is that one of these sectors is more of an early cycle sector, the energy is more of a late cycle sector, and then the telecoms is more of a middle recession cycle. So we're kind of in a cone of confusion, right? It's like nervous water that's boiling. It's trying to find its direction. So the economy is really trying to find its direction. But the defensive sectors did make a comeback in this last quarter. So we can see here that you've got the energy, communication services, and financial sectors as best performers, okay? And then if we want to look and see what's in there, we can see that for the communication services, you have Meta and Alphabet at the top, and the energy of Exxon and Chevron and Schlumberger. And then in the financial sectors, you have Berkshire, JP Morgan, Visa, etc. And we're seeing those sectors making a comeback. So we're seeing some rotation there into those defensive sectors. So again, just as a quick review, our value proposition as an active manager is that we're trying to build robust and prudent and purposeful portfolios by blending all of this work, by blending fundamental work, technical work, economic work. We're looking at quantitative methods and fundamental analysis and looking at modern portfolio theory and dynamic asset allocation models. So we have 25 plus portfolios. And so we're always going to have something that's working. I wish we just knew ahead of time which one that was going to be, but whether some of our portfolios are shorting the market or in cash or all long, we're going to have something to help you navigate through these cycles, okay? And again, if we went back and looked at those cycles, if we're nowhere at the bottom of a cycle, we're going to want to be in more of the equity portfolios, the risk-on portfolios. If we knew we are at the top of a cycle, we'd want to be in the more conservative investments, right? In bonds and cash and treasury bills. And if we're in the middle and we're not sure which way to go, we want to be more allocated, right? We want to have a little bit of everything to try to hedge the risk and be more balanced. Okay, so the cycles and the sectors, or the sectors and the cycles, and the rotation of the sectors within the cycles really aid us in our active management. Okay, let's take a review of what happened. In reviewing last quarter, everything's driven by supply and demand. And we can see here that the red line, which is the selling pressure, the sellers are in favor, has come back up. Last quarter, the black line was up, and it was that the buyers were in favor. So right now, there's been another shift from buyers to sellers, and we can see that happening all year long, where it goes black to red, black to red, black to red. There haven't been long periods of trend throughout the year. There's been a lot of oscillation, but currently, right now, the sellers are in favor. Okay, now what we're going to look at here is we're looking at the S&P 500, and you'll notice that last quarter there was 156 companies that were up and 354 down, and we're going to see this rotation happening here, right? So here we can see that the top performers of the index were Alphabet, Lilly, ExxonMobil, Nvidia, Meta, right? We've got a lot of healthcare and oil, energy up here. And the laggers for the quarter were Apple, Microsoft, Tesla, Amazon, okay, Netflix, which of course last quarter, those were the leaders. And so we have had some rotational shift last quarter, and we have had a down quarter amongst not only the S&P companies, again, 354 down, but we've had the majority of the sectors down. Again, what we're going to see here is that the oil and gas and energy has been up here at the top, S&P's down here kind of in the middle, and then down here we see the gold and the metals and the real estate, which are, and utilities, which are, defensive types of investments typically, down towards the bottom. Okay, and so this is just the rotation that we've seen since last quarter. Let's talk about a recession. Well, we've seen this slide before, and we don't know when, how long, how deep, or if a recession will come at all, or what the Fed will really do, okay? But we will look at some charts and some data that we think we can make heads or tails of. So on this graph, what we're looking at is the change in unemployment. Again, the absolute level of unemployment isn't as important as the rate of change. And so on this red line, we can see that if unemployment goes from 0 up to 1, a change in 1%, then that is a good indication that a recession will follow, at least if we look at the historical chart here. All these gray bars are recessions, and you can see every time the red line went up to 1 from 0, that a recession follows. So can we say that's going to happen again? We don't know. There's always the time that that doesn't happen, but historically, that's the evidence that we see. And we're going to talk a little bit more about the unemployment rate in a few slides. Okay, here what we're looking at is the recession models. This is the S&P 500. The red bars are recessions. Here we have the New York Fed's probability model at 56% of a recession, and the Bloomberg's model is at 100%. So again, there's a lot of people out there that say we're already in a recession, and we'd see that as evidenced by the Bloomberg report there. But we want to look at surveys and other data as well. So here I'm going to skip to the economic leading indicators, which you can see the blue line has been coming down. You can notice the GDP, the gray line, has actually come down, but it's turning back up. And so, typically the old definition of a recession was 2 declining quarters of GDP. And here we can see that GDP is still holding in there pretty strong. And the leading economic indicators have turned around a little bit. When we look at the survey, we can look at the survey from Bloomberg, and 55% of the people they surveyed think there's going to be a recession. So again, kind of right in the middle of that bell-shaped curve. What we're going to look at here is what causes a recession is the contraction in the economy. The contraction can be measured two ways. Once it can be measured through the rear view mirror of the car, right? We can look backwards of where we've come, and that's GDP. Or we can look through the windshield of the car and where we're going, and that's going to be the ISM indexes, both the manufacturing index in green and the blue line is the services index. And so you'll see here that the services index has been pretty strong. And although the manufacturing is dipped below 50, and anything below 50 is contractionary, that's the red line. Anything above the red line, above 50 is expansionary. So you'll see that it's turned back up, okay? But when we want to look back here in this time period, back in the 90s, this is what a soft landing looks like. right? The economy was really doing well, so the Fed raised rates. It started to cool the economy off, but a recession didn't come, right? So they paused rates, the economy took off. Here again, we see the economy started to have a long cycle here, right? It was above 50 for quite some time, several years, and the Fed started to raise rates to cool it off. They paused. The economic activity as measured by the ISM indexes was, substantially below 50, and then a recession happened. Okay, well, when that happens, the Fed cuts rates. Of course, that causes a market run, and then the Fed went flat. The market continued to grow. They got worried. They raised the rates. They pause. Recession happens. So you can see this is that cycle that we talked about earlier, right? Here, you can see that this is the business cycle. And since the Great Recession here, or Great, whatever we're calling it, with Great Recession, but 2008 on, you can see this long period of zero rates caused the longest expansion period, I think, on history until they, started raising rates. COVID, it broke it. Zero rates again, great economic activity, and so you get the story. The Fed will lower rates to get the economy going, and they raise rates to slow it down, and sometimes they break it and a recession comes. Right now, we're going to talk about when they may pause. Now they've already paused once and then they raised again. And now we think they're going to pause again. So it's kind of been raise, pause, raise, pause. But right here, the federal funds rates are at 5%, and the PCE year over year number is at 3.8. And so that's a good relationship. Inflation is coming down. Here we're going to look at the Taylor rule. It's just a formula to kind of say where should the rates be? What should the federal funds rate be so that the economy is not contracting or expanding? And that's what the Taylor rule shows. And that mainly looks at the expected inflation and unemployment. And so here you can see the forecast for inflation at 3.75 going down to 2.6. And we can see unemployment going from 3.8 up to 4. So remember earlier I said that 1% rise in unemployment could be a big telltale sign. It looks like we're going to just barely miss a 1% rise in inflation. So we've shown this before. We like to show a lot of the same charts and graphs over and over and over to help you learn. We think there's repetition helps you, but it's also what the data we're looking at, right? So the data may change, but what the data points that we look at don't change. And so here what we're seeing in this white line is S&P 500. And normally when the Fed pauses, the market rallies in anticipation of the Fed having to drop rates. And so you can see that in these three boxes here. Now, right now, here the Fed funds is drastically and it's leveling off, and the market has run pretty well. This year it's still up as of this recording, about 13% or close to it. So even though the quarter's pulled back, we still had a pretty good year in equities. And for the most part, they were expecting the Fed to pause and then slow down, and that's what made the market rally. Now, if they break the economy, we're gonna see a sell-off, and we'll look at that next. Okay, so how would the Fed break the economy, and what's going to make the market rally? Well, there's only a few things that really are at the core of driving the equity markets. That's inflation, the interest rates, corporate earnings, the Fed, and geopolitical events, of course, weigh in on that. And then we've seen the market cycle again. So if inflation continues to fall and corporate earnings continue to go up and rates start to fall and the Fed is accommodative, we would expect the market to avoid a recession and continue upward. And the opposite would be true, is that if inflation does rear its head back up, interest rates do continue to rise, corporate earnings continue to fall or are suspect, and the Fed remains restrictive, well, then we could be kicked into a recession. When we look at inflation, the top chart shows that the Fed wants you at 2%. That's the red line. The orange line is the PCE. That's a measure of inflation, 3.5, and the University of Michigan's survey for the next 5 to 10 year inflation outlook is at 2.8. The purple line is the University of Michigan's 1 year expectation of 3.2, and the CPI is at 3.6. And so you can see that all measures of inflation have really come down. The CPI is ticking back up just a little bit here, and we see this just a little bit here on the PCE. And so there is some talk out there that we could see inflation rise again, especially in food and energy. So we'll keep an eye on that. But in general, inflation has been coming down as the Fed has been raising rates. The 10-year, of course, we've been talking about this for several years now. This rise in the 10-year has really caused the stock market to cool off, and we'll show some more charts on that in a moment. But the 10-year is really what the market's focused on more than inflation, even though inflation assumptions are built into the yield assumptions of the 10-year. The market is really focusing more myopically on the 10-year Treasury and whether it will go up or down. So with that, we still have an inverted yield curve, but a lot of the research shows that even though we've had an inverted yield curve, which is a strong indication historically for a recession, although not perfect, a recession usually doesn't happen until the rates start to rise again. And so we are starting to see the long end of the curve rise. Okay, so that's worrying some people that, okay, the yield curve was inverted, it's starting to rise, and that could be an indication that a recession could be around the corner early next year. On this graph, what we're looking at is the gray line is where the yield curve was last quarter, and the blue line is where it is now. So you can see there is a shift up in those long rates, and the short-term rates have stayed flat. Now, a couple things could happen. If these lower rates come down, right, then the yield curve is going to right itself. It's going to be in its normal concave shape. Or you could have these rates stay flat, and these 10-year rates could rise up past that expectation of the Taylor rule and go up to 6, 7, 8, 9, 10, 12, 13, 14%. And that would also shift the yield curve back into a positive indication. So we'll have to just wait and see how it moves, but those are the things that we're watching right now with the shape of the yield curve and where it might be moving. On this chart, we're showing the yield curve and the stock prices. So here's the level of the S&P 500 on the y-axis, and on the x-axis is the 10-year yield. And so you can see here as yields go up, okay, so as these yields rise from 3.7 to 4, causes the market to go down. And of course, the opposite is true. Falling rates, when rates go from 4.3 to 3.7, then the market actually increases. So this is why I was saying that the market is really concerned with that 10-year interest rate. According to the Federal Reserve's dot plot, which is the expectation of rates per the voting governors, you can see that the rates are continuing to come down, okay, 24, 25, 26 and long term. But here we can see that the yellow lines and that median is right in here. And so again, we are expecting, maybe another rise, but the futures markets are really saying that there's a lower probability that they're going to raise either in November or December this year. So again, rates look to be stabilizing. They don't have to come down. They can stay at 4 or 5% for a while, but there's some evidence that it looks like the Fed funds rate will not continue to rise much further. Moving our attention to corporate earnings, the green line are the trailing 12-month earnings of the S&P 500. The blue lines are the best expected earnings 1 year from now. And so you can see that we go from 219 to 217, and that's a contraction of about 1%. Last quarter, that was closer to 3%. So even though it's negative, earnings appear to be improving. So what's all this mean? Well, if we look at where the market is today at 43.08, and we look at where the Bloomberg market consensus is at 51.20, that still has a consensus estimate of a return of about 18.5 or 18.85%. Now that might be a little high when we want to confirm that with the VIX. The VIX is saying that we're probably closer to 17% on the high, which again could go up 17 or down 17. But this is where consensus estimate is. And this is, again, why we say that the expected 12-month return on equities is higher than its long-term average expectation on equities. Okay, so what's our outlook? Well, again, like last quarter, we're neutral, we're hopeful, and we're concerned. So we're neutrally, hopefully concerned. So we're neutral across the board because it's a nervous water, it's a cone of confusion. We're still waiting for data to show itself and see which way we're going to go. So we still recommend caution in your portfolio. Over the next 12 months, we expect risk versus inflation to continue to battle, but the inflation is coming down and risk assets have been doing well over the year, even though they were out of favor for the quarter. You can never fight the Fed. The pause came, then they raised, and then they paused. So Treasury yields may continue to be rising, but the Fed funds is probably getting close to the end of the cycle. Interest rates, the yield curve is still inverted, but is shifting. We're definitely seeing increased opportunities for active management and focused allocation. We like our stock selection. We like our stock and equity portfolios right now, but you remember you have to be patient. You can't just, last quarter Amazon was great. This quarter it wasn't. We're not worried about any one quarter. You can't just buy and sell all the time. So again, we're willing to hold these world-class companies and deploy some patience. Last quarter of 2023, a possibility to run and continue to have increase in returns, unless there's a recession or a geopolitical event that could, change the market's course. Risk management, again, was a popular strategy for the quarter, but it's losing out to the risk on trade year to date. Corporate earnings, again, have been pretty resilient, but we still stay tuned. The banking crisis, we still think that the banks are tighter on their credit. They're still trying to shore up their balance sheets. So, we're not out of the woods yet, but at least it's maintained for the moment. Okay, so we always like to kind of get to the end of our presentation with what should you do? You should hold enough cash to make yourself comfortable so you can ride out the storm. You should evaluate your time horizon and your other factors that go into the investment policy statement. Make sure that you communicate those to your advisor so that we can change your portfolio if necessary. And then, of course, you need to be a little bit patient. What are we going to do? We're going to continually manage cautiously. We're going to continue to look at the data as it shifts. We will continue to analyze, investigate, and communicate that data for you. And those are the three things that we really do as analysts, right? We investigate, we analyze, and we communicate, and we'll continue to do that. For those of you that want a little more detail, let's just jump into part 2 really quickly here, and I'll finish up in just a couple minutes. Here's the chart showing that the money supply has been shrinking rapidly, so it's taking a lot of liquidity out of the market. That's also been helping fight bringing down inflation. Here we see that the style of growth in investing has been in favor over value. Here we can see that the large companies have been in favor over the small companies. When that purple bars are up, that means growth is in favor. When the purple bar is down, it means that the smaller companies are in favor. So again, last quarter, we still saw the larger companies prevail. Here we're looking at, is the market in a equal weighted mood or in a market cap mood? And as you can see here, year to date, the market is up 12% based on the market capitalization. Again, those are the larger, well-known names that live at the top of the S&P 500, have been driving the majority of the returns. And again, if you just would have gone out and bought an equal share of all the companies in the S&P 500, you'd actually be down this year about 1.3%. So some interesting things that we look at and help us know where the market may or may not be going when we look at the market capitalization of these indexes and these sectors. When we want to look at the fundamentals, we're looking here at energy, telecom, materials, and financials being the top 4 sectors. And again, we saw that some of these sectors were really shining this quarter. Now, we were still having these companies in favor earlier on in the year based on the fundamentals, but they just didn't pan off yet, right? And now they're starting to pan out. So these are the defensive sectors that we talked about. So this is just where the fundamentals are when we look at these, the price to earnings ratio, the earnings per share, price to book, and debt to capital. When we rank them, we see energy, telecom, materials, and financials looking to be poised, fundamentally speaking. When we look at the VIX is the volatility fear index. It kind of helps us know what the market's thinking based on volatility. Up here, we can see that based on a VIX of 17.45, it implies about a 17% move in the market. Again, we don't know which way that's going to go, right? If it goes up 17%, that means it could go as low as 35 and as high as 5,042. If we want to look at that move based on the implied volatility of a direct measurement, that'd be the S&P 500 itself, then that volatility shows about a 12.17% move, which would put you at 37.84 to 48.33. Okay, so again, I think that estimate of 18% from the consensus estimate is a little bit high. It's just a little bit outside of the return as measured by the VIX. Again, if the estimate was 16%, I'd say, okay, so it's within this range. If it was 15, it'd be within this range. At 18 plus, it's a little bit outside of that normality for me. Okay, So with that, I'd like to thank you for taking the last half hour to listen to me ramble on again. I hope you appreciate it. I hope it gets some value for you. We love to do it. We love serving you. We thank God for you every day, and that we're very blessed to do what we do. So thank you for your trust and your patronage, if I can say that today. And we look forward to, speaking with you. If any of you have direct concerns or questions, please feel free to reach out to us. And other than that, we will continue to put out our weekly videos and writings and our monthly commentary. And of course, at the end of the year, we'll do another market update, do a year-end review recap for 2023. And of course, we will give you our 2024 outlook. So with that, I'd like to thank you again. My name is Joe Mass, and thank you so much for listening today. We appreciate you. Bye-bye.